Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Wednesday, the Federal Reserve came out and said we are raising interest rates yet again, this time by 0.25%, also known as 25 basis points. In this video, this podcast, whatever way that you are watching and listening to this, we need to talk about what this means for investors, as we do every single time they raise rates. But this one is important. Each one is important, but this one is even more important because it's the smallest one that they have done. Now, each of the 7 times last year, at least in the beginning, they were raising rates by 0.75%. Then they did it by 0.75% again, and then it was 0.5. And these were significant hikes in interest rates, and almost immediately in some cases you would get an email the next day from your bank saying, boom, we're raising your interest rates. Mortgage rates have doubled, things have gotten more expensive, and spending and inflation have slowed down. In December of 2022, we found out that consumer spending, this is the money that me and you all spend together, actually dropped 0.2%. Okay, 0.2%. We spend just a tick less than what we normally spend. And we also know that inflation is down to 6.5%, which is lower than the 9% that we had around this time last year. So these are relatively good indicators that the rate hikes are working, but also the importance of just raising it just minimally this time around is telling us this. The Fed is concerned, and they are saying, look, we're going to continue to raise rates, and they also said they're going to continue raising rates. They didn't give us a number, though, but they're not going to push us over a cliff. Or at least they're not going to try to push us over a cliff and put us into a recession. That is what they are attempting to avoid, which is what makes this small interest rate increase important, but still significant. So that is what's going on. Now, for those that don't know, when they raise interest rates, they make money more expensive. When you make money more expensive, you slow people down. Okay, it makes you think twice about going and buying a house, taking out a loan, getting a car, so on and so forth, which is why we have seen inflation come down just a bit. But it is a balancing act. You don't want to slow down the economy so much that you go into recession. You just want to slow it down just enough to bring things down to a reasonable level. Their goal is to get it to 2%. According to some economists, there's a 61% chance of a recession in 2023. Now, these economists, I consider myself an economist sometimes because that is what my degree is in, have been right in some cases, but also wrong in a lot of other cases, because in the beginning of the pandemic, or really the end of the pandemic, as we started to see inflation, we said that this was quote unquote transitory. Now, you never actually heard me use the word transitory, but Jay Powell, the chair of the Federal Reserve, and many other economists were saying that, hey, look, that's what happens, right? You're in a pandemic, everybody's locked in, nobody can go on vacation, now you're out, you spend so much money, and eventually inflation will just go away on its own. That ain't what happened. Okay, that's not what happened. It made sense, but that's not what actually happened. So this is what's going on now. They're continuing to raise interest rates, but trying to slow things down to a reasonable level. Right? That's really it. That's all that we need to know. What you should invest in remains the same, because everything we've been talking about so far this year and really the second half of last year still holds. And until they stop raising interest rates, I will continue investing the way we have. So whether it's insurance, healthcare, defensive stocks, infrastructure stocks, all this stuff is still going to make sense. All right. If you got any questions, let me know in the comments below. And that is it for me. Talk to you later.